Hello, let us look at an illustration of how the accounting equation remains balanced at any particular point in time, okay? So we are going to use this scenario where we have Salim, who is an entrepreneur who wants to open a business of selling televisions. And the first transaction he does is taking 500,000 from his savings and transfers the cash to the business account. Okay, so this is basically owner's equity. Let's assume this is a sole proprietorship, and there is going to be a transfer of cash from his bank to the business bank. Okay, so this is what we're going to call owner's equity. And then there's also going to be the cash account. Okay, so these are the two main accounts. These are the two accounts that are being affected by this transaction. Recall, every time you see a transaction, you need to ask yourself which accounts are being affected and now how. Now for the owner's equity, there is an increase into the owner's equity account because there was no equity before. Now we have an equity of 500,000. So this is an increase to this account, and to increase an equity account, what do? We credit that account. Okay, recall the expanded accounting equation. You can see equity is on the right side of the accounting equation, and when you want to increase equity, you credit that account. Okay, so on the other end, note that now the bank account has also received 500,000. Let's assume initially it was at 0, and now we have the balance for that bank, for the business bank account at 500,000, which indicates that's an increase to that account. And to increase a cash account, which is an asset account, you do what? You debit. Okay, refer again to the accounting equation. You're going to see asset is on the left side, and to increase an account which is under assets, you debit that account. Okay, so here we are definitely seeing an increase of 500,000, and also we are seeing an increase of 500,000. So when you record this first, we're going to basically record a debit cash account, an amount of 500,000. Okay, and then we're going to credit owner's equity. Remember, we are recognizing an increase to the owner's equity of amount 500,000. Okay, now let us look at the accounting equation. The accounting equation is basically assets is equals to liabilities plus equity. Okay, the assets in this case, we have the cash account, which has a balance of, as of this particular point, and after this transaction we have a balance of 500,000. And then the liabilities, we don't have any liability as of this point after this transaction. Then we have equity, which is 500,000. Okay, so basically 500,000 is equivalent to 500,000. So the equation is balanced. The equation is balanced. Okay, so let us look at the second transaction. Remember, the equation is balanced this way as at this particular point in time after this transaction. So let us look when we get to the second transaction, where the business purchases 10 televisions at Kenyan shillings 20,000, and they paid 100,000, and then the business will pay the next 100,000 next month. So first, you need to know the value of the televisions that we have received, that the business has received. That is the inventory, which is basically 10,000 multiplied by 20,000 multiplied by 10. So we're going to have 200,000. So we need to recognize the two accounts that are being affected. Actually it will be more than two. So we have inventory account because there is an increase in the inventory account because we are receiving these 10 televisions, and we need to debit inventory account to recognize this inflow of inventory of value of 200,000. Okay, then you're going to look at the second account, which is the cash account. These they paid an amount of 100,000. This is basically money is coming from the business bank account to the supplier of this television. So that is going to be a decrease. Is going to be a decrease to that cash account. And when you want to decrease a cash account, which is an asset account, you credit that account. Okay, and we are going to be crediting, we're only going to credit 100,000 because that is the amount we paid out. Okay, so recall the total debits are usually equal to the total credit. So far they are not. Why? Because there are some items that we've not paid half the amount of money, so we need to record the obligation of paying this remaining amount, which we record in account called an account payable. Okay, so our account payable, what is happening is it is increasing because we need to recognize an increase in the amount we are required to pay. And an account payable is a liability account, and when you want to recognize an increase in a liability account, you credit that account, and the amount that is due is actually 100,000. Remember, we were supposed to pay 200,000, but we only paid 100,000, so the remaining amount is 100,000. So this is going to be basically a debit inventory account, then you credit an amount of 200,000, then you credit cash account to recognize the decrease in that account of 100,000, then you also credit again account payable to recognize an increase of amount 100,000. Okay, so you're going to see now the debits are going to be equal to the credits because 100,000 plus 100,000 is 200,000. Okay, always refer to the accounting equation to guide you when to debit and when to credit. Okay, so you can see for liability account, when you want to increase it, you credit. Okay, so this is what I am referring to when I am doing this. Okay, so let us look at if the accounting equation is going to be balanced now after this equation, after this transaction. So we left from our previous transaction, we had assets of 500,000, we had a zero liability, we had equity of 500,000. Now we have reduced cash by 100,000. Okay, so cash is an asset account, but we have increased inventory by 200,000. We have increased inventory by 200,000. Don't forget, inventory is an asset account. Do we have a liability? Yes, we have a liability of 100,000 from our account payable. Okay, and our equity will still remain 500,000. Okay, so let us sum these. We're going to see 500,000 minus 100, that is less 100,000 that has been reduced from the cash payment outward. So it's going to have 400,000. Then we add 200,000 and we're going to have 600,000. And from this other side, we're going to have 600,000. This is going to be, the accounting equation is still going to be balanced. Okay, now let us look at our third transaction where we are told the business takes a loan of 400,000 because the business wants to purchase another type of television. So what has happened is the two accounts being affected is cash account because they're taking the business is taking a loan and it's going to receive in cash of amount 400,000. That has an increase to the cash account. And to increase the cash account, what do? You debit that account, okay? Then the other account that is being affected is what we call the loan payable. The loan payable account. This is where we record the liability, that is the obligation to pay this loan. The obligation to pay this loan, and we need to recognize an increase to that account. And when you want to increase a loan payable account, which is a liability account, what do? You credit an amount of 400,000 in this case, okay? Remember, I am referring to this equation when you have a liabilities. When you have liabilities, what do? You credit that liability account to not to recognize an increase in that account, okay? So here, basically, we are going to have debit cash account, an amount of 400,000, and then we are going to credit our loan payable account, an amount of 400,000. Now let us look at how does the accounting equation fare now at this point. Okay, so we left when we had assets of value 600,000. We had liabilities of, we had a liability of 100,000, and we had equity of 500,000. Now this is from our previous second transaction. As at that point, now we want to look at the accounting equation now after the third transaction. And we can see there is an increase in the cash account, which is an asset account. So we need to recognize that increase. So we need to, sum to add that 400,000, okay, onto our assets. And then now we have an additional liability, because a loan payable is a liability account. So we're going to have 100,000. We add 400,000. Okay, our equity will still remain 500,000. So here we're going to have 1 million. 1 million. Here we're going to have 400,000 plus 100,000 is going to be 500,000, plus now 500,000. We're going to have 1 million on this side. Again, this is balanced, okay? So basically, the accounting equation is the concept behind the double entry accounting system. So at every particular point in time, the accounting equation will remain balanced. If you see your assets are not equal to the liabilities plus equity, then that means there's something you're missing. You need to look back and find what have you missed, okay?